Well, the S&P is making new year lows. Check that out. Um, so we had a mark. I'll say it that way. Here we'll just do it this way. Zing. So we had this high up here at and I'll circle it here. Get a little pencil out right there at that 61, 66 and a half. If you do a 10% correction based off that, that puts you right down at basically 55.50 right there. And so usually when they have no normal corrections in the market, and that's what basically they're saying a 10% correction is, it's just kind of normal. Um, they'll usually go somewhere between 10 and 12%. If you look at the 12% on the S&P, that puts you down at 54.27. So right now we're at 55.20. So basically 90 points or so from here is what we can probably see. One thing that's kind of interesting about that is if you kind of look at the average range, where's my little, there we go. We look at just kind of the average range of the S&P over the past 14 days. And I'll trash out these things. We've got about 125 point range in a day right now. That's on average over the past 14 days. So to make it to 12% down would really not take much at all of a day, right? But like I was saying, I mean, I've been kind of expecting this. I think the big thing today was that Putin pretty much rejected the ceasefire over in Ukraine. So of course that puts the market in mayhem. The sky's falling and everything else. But the market's always going to kind of overreact to everything it does. So that's just kind of typical of what the market can do. If you look at a huge picture, this is just a little blip down over the, no, if you just go back to 2010 to now, we went from 666 in the S&P up to 6,100. So it didn't go up 10 times, but almost. So a little 10% back's not going to mean just a whole lot in here. So I'm not too worried about it. The big thing is like we were kind of talking about last time we were together. I don't know if anybody, bought any pocket puts or anything like that, or bought puts on the SPY, but they're paying you pretty well, which is really nice. So, and that's really what we have to do a lot of times. And I mean, I'm actually having a better day in the market just because of those puts, and plus, gold and silver are in cruise mode heading up. Gold made a new all-time high today, um, and which is nice and strong. The one thing that I'm kind of worried about, to be honest with you, let's look at gold real quickly. There we go. Here's gold. This is a daily chart on gold. You can kind of see it's just been moving up. And had a little consolidation in here. Oh, no big thing. And now we're making new all-time highs. We're coming up to 3,000. Any century mark in gold is going to cause some issues. So my question is now, do we come up here and tag 3,000? Does gold correct back to 2,900 or 2,850 and then turn back around and try to bust through 3,000 again? That wouldn't surprise me. But if it takes out 3,000, so be it. We'll be, riding right along with it. But I think gold's going to continue to move higher over the long haul. But this is kind of the normal kind of consolidation that gold and silver do, in the first quarter of the year. Historically, that's what it does. Seasonally, it's what it does, if you want to look at it that way. And now we're starting to kind of break out of that a little bit. But coming up to 3,000, new century mark, right? So that's the one thing that we have. I mean, if you start looking at all the tariffs and everything like that, they've kind of scooched those things off to the April the 2nd, except on China. Of course, that came out on Monday. We had CPI and PPI come out this week, and the CPI numbers were a little less than expected. So the market jumped up off that and then immediately turned back around when the market opened and sold back off, only to flip back around and rally back up, right? So we've had some very volatile days. And we had the PPI come out, and it was pretty much in line to a little bit below expectation. The thing is we still have inflation. It's just not going up as fast as it was. We were still up, 2.1% on CPI, so we're still paying higher prices. It's just not as high as it could have been, like we were, going up at 8% a year as opposed to 2% a year. There it is. So until those things actually go negative, where they start decreasing in price, which is kind of unusual, but um, another thing that we've got is GDP right now. People are starting to wonder about in a recession and stuff like that, and I think it's actually a little bit founded. You look at the definition of a recession. The definition of a recession is basically two negative quarters of GDP, right? That's kind of the way they look at it. And if you look at, there's a website, where is that thing? I've got it right here somewhere. There it is. The Atlanta Fed GDP Now website. Here we go. You'll notice right here, right there, you notice there's a negative right now. It's negative 2.4%. So they're actually expecting the first quarter of this year to actually be negative on GDP. Well, if you have one negative quarter on GDP, all of a sudden what? You're halfway there, right? So that's the one thing that we look at a lot of times in the markets is, are we going to go into recession or not? Well, if we do have a negative 2.4% on GDP, and we won't really get this reading, if you think about it, we haven't finished the first quarter yet, right? Well, this is the last month, so we're not going to get this reading until the end of April. So we got 6 weeks here before we're actually going to see what this number is. But right now it's negative, and that might flip back around and turn positive, and all of a sudden this is a moot conversation. Since we still have 6 weeks. So, but a lot of people will start watching this, especially going into next month. Well, what else happens next month? Oh, earnings again, right? And we still have earnings coming out. I mean, what is it? Next week we have what? A lot of earnings coming out. We have Nike and Micron and FedEx and Jabil, Darden Restaurant, all kinds of stuff coming out next week. So it's going to be kind of interesting to kind of see how the earnings actually occur, and then all of a sudden we get to see what GDP is. Now, odds are after the first quarter here, it wouldn't surprise me that earnings aren't as good next quarter or for this quarter. I mean, you've already seen the retailers kind of starting to get beat up a little bit, right? And if you look at the transportation stocks, man, they're getting hammered. I was out, looking at the airlines and the automakers and stuff like that, and they're not faring too well. And I think they're getting beat up, A, because of a slowing economy, secondly, because of tariffs. And so everybody's kind of worried about that. And so I think that's going to probably continue on for a little while. But I mean, Trump's been yelling and screaming to everybody, hey, it's going to hurt at the beginning, and then everything will turn out to be a whole lot better. So I agree with that. And so I think we'll probably, be in a little bit of a hurt mode. I think you need to have protection and everything like that in your account, just to make sure you're hedged well. If you're go ahead and hold all your stocks and stuff like that. But I think going forward, and I'm talking about in several months here, things will start looking a whole lot better, especially next year. I mean, once everything, the big thing is can Congress help out? That's the big thing. I mean, Trump can't do it on his own. Congress can help out, then maybe everything starts perking back up. But there's going to be a big old fight in Congress, then that ain't going to happen. Next week, speaking of retail sales, we're going to get retail sales on Monday. So when we kind of start out next week, we're going to find out real fast if how retail sales were last month. We'll see if they're negative or they're positive or whatever they may be, but they're going to be there. We'll also get some housing price indexes and stuff like that next week. That should be kind of interesting. Of course, we'll still get the EIA petroleum status report. And so I think also we have a Fed meeting on Wednesday, right? And then on Thursday, the the Bank of England does their interest rate stuff. And then we're going to get the Philly Fed index, then get existing home sales. So we still have a lot of news coming out next week to see what else is going to happen. As much as the market has gone down, which this is hurting IRAs, 401ks, investment accounts, especially. They don't ever step back and say, well, where were we 2 years ago? Well, we were above, we were way below here a couple of years ago. So, I mean, they're just going to be losing a little bit. I mean, we haven't taken out last year's open or anything like that. So you're still above where you were last year. Ta-da. We just made new all-time highs. What was it, last month in the S&P? So we've corrected that back a little bit, but I wouldn't be too afraid, too scared. Don't get panicky. This is just, like I said, a normal correction in the market, and it happens. And it needed to happen. I mean, we've been in cruise mode in the equity markets, and things just needed to kind of chill out just a little bit. And you kind of were noticing there was a huge disparity between the hedge fund guys. And I think I mentioned this, I don't know, several weeks ago, but there's a huge disparity between hedge fund people and the retail people. And when you start seeing that, usually the hedge fund people went out, which where the big money is. And they've been either selling their stock or shorting the stock. And all the retail people, that's the yous and me's out there just buying stocks like crazy. And well, you can kind of see here now the people who are buying all those stocks are kind of getting hammered a little bit. So that too shall pass, and things will kind of chill out. But I think it's really interesting that coming into the middle of the month of March here, just like we did back in pandemic or back in the financial crisis or even in the tech bubble, they're hitting the lows coming into the middle of March. So it wouldn't surprise me one bit they don't flip this thing back around and off we go again. But they did need to kind of shake things out a little bit, but don't be too worried about it. But one thing I would definitely watch for is that 3,000 level on gold. And if it hits that and backs up and just kind of starts yanking back a little bit in here, don't be surprised at that at all. That's just normally what gold does. It hits a century mark or whatever it is, a millennial mark, and it's gonna hit that and back up. And just sellers come in when it hits something like that, and they'll usually pull it back anywhere between 50 to 150 points before it runs back up and tries to challenge it again. So if you're buying gold up here, no problem with that. You're just going to have to take some heat. There it is. But anyway, that's the one thing that I kind of see in the markets right now. And I mean, the S&P was, it quote unquote was trying to recover. It did a ricochet once it hit 10% down the first time. It went up, it failed, went back down and retested it. Went up, it failed, came back down and retested it. Went up again, and then all of a sudden today just said, okay, the heck with this thing, and they just busted it. So now the question is, let's do this slash. There we go. You've got a weird phenomenon coming in here right now, and I'm going to explain this to you because it's going to happen before we meet again next week. Right now we are trading the March S&P. All right, we are trading the March S&P. We opened up the year on that futures contract at 59.49. All right. Now we're down here at 55.39, which we're a long ways from there, flat out. I mean, we're 400 points from that spot. Here's your highs up in here. But come Monday, they're going to roll this futures contract over. Hold on. Let's pull this one in real quick. There we go. Chart looks the exact same, but you'll notice here, if you look at the high of this contract from where we were, there we go. That was at 62.25, not 61.66. Big difference, right? And we're here at 55.88, which we still have that same 10% correction in here. Don't get me wrong. But we're going to come in next week marked up, if you will. We're going to be basically marked up about 60 points in the S&P. And so everybody's going to come into these new numbers when the contract rolls over and go, oh my goodness, where are we now? So, and you'll see this sometimes. I mean, they attempt to quote unquote fill the gap, if you will. So they may next week try to either take this contract, the June contract, down to 55, 20 or whatever it is, and then flip it around, or they're going to try to pull the other contract back up. But there's always a battle during that last week. Expiration is actually on Quadruple Witching Day, which is next Friday, a week from tomorrow. So you're going to see kind of a battle there of which contract is actually lead and which one's going out and which one's coming in and how they're going to do it. But usually Monday and Tuesday, they'll try to reconcile that out a little bit. And then everybody's used to the numbers. They're still going to be using the same year open. But you'll notice we opened up at 59.49, right? Well, this contract opened the year at 6,005. So like I said, there's no 50, 55 points, 56 points difference between the two of them. People are going to have to get used to those numbers back again. And that's just what happens when you have contract rollovers all the time. So, and you'll see things get marked up and marked down. That's one reason why I don't like trading UNG. UNG is an ETN, not an ETF. You have like USO is an ETF on crude oil. Okay. There it is. But UNG is actually an ETN. And it'll really irritate you sometimes because you'll be long because natural gas is going up, right? So you'll be long UNG. It'll move from $20 all the way up to like 22 and a half, $23. You're looking all awesome. And then you come in the next day and it's trading at 21 and a half. And the reason for that is this contract rollover. They had to get rid of those futures contracts, go into these futures contracts, which were marked down lower because they're at a discount in the future. And all of a sudden, you have to correct that ETN down. And that's the problem with trading ETNs based off of the futures contracts, is that they use forward and out contracts. They'll be long these and short those. And all of a sudden, when they start rolling those things over, it'll readjust those ETNs. So you have to be very, very careful about that. ETFs work a whole lot better just because they're all based off of equities as opposed to futures. And there it is. So, but we are going to have that rollover come on Monday on the index futures. That's the SP, the Dow, the NASDAQ, the Russell, the S&P 400, whatever futures contract on the indexes you look at, those are all going to roll over from the March contract to the June contract, and then kind of go from there. So do beware of that. And so people might be quoting the futures at a different price, and you're like, hey, man, that's 60 points higher. Well, yeah, it is, just because that's the difference between those two contracts. But right now, and let's go back over here to what we're used to looking at. Right now, we're at 55.35. One thing that'll be really interesting is if they close below that 55.50, which is your 10% correction. They close below that today. I don't know. I'm going to say that's going to be a weaker sign, and we might try to hit that 12% down. Wouldn't be surprised if we don't get down to 54.27 or 54 and a half or 54.50 or whatever on the S&P. So just beware that can be that way. All right. But this thing's probably not done yet. I was hoping they were holding that 10% correction area, which they did it 3 or 4 or 5 times. And today they finally just said the heck with it and they just flushed it out. We went down to 55.10 basically. And now they're trying to bounce it a little bit here. But the question is can they really do it? I mean, here we are on a 30-minute, you actually have a higher high, higher low coming off of where we were, but they haven't gotten back above this 55.50 area in here. And until they do, you know, this is just a little, you know, little relief rally, if you will, before they kind of roll it back over. That's what I was kind of worried about, wondering about this morning. When they came down, they basically sold off, right at the opening bell. Then they flipped it back around and just ricocheted the thing and actually went out and took out the high of the opening range, opening 30-minute range, only to then just sell it right back off again. I mean, most of these bars are about, between, 30 to 40 points in the S&P. And that's a lot of movement in the S&P when you're looking at 30 to 40 points on the futures. I mean, think about the risk. I mean, at, $50 a point, you got to risk, 50 points on the thing just to, stay out of the noise. That's crazy. That's $2,500 that you got to risk just to see if you're going to be right. That's nuts. So, and that's just intraday. So basically what that's saying is we got a lot of volatility in the market, and my guess is going to kind of remain that way. And so there it is. And in fact, if we look at, did they pull this up? There we go. You can kind of see here the old VIX has been spiking up here. This is the VXX. And this is an ETN also, just beware of that. But this is based off the VIX futures off the CBOE. But anyway, you can kind of see we've been kind of spiking up here a little bit. If we just kind of look at the swing side of this thing, there's the VIX. And they've kind of shot this thing up. And now they're trying to figure out, are they going to, continue to have more volatility or not? So if you're trying to figure out there's more volatility, just flip over to the VIX. It'll let you know. But anyway, that's kind of where we're at. We got lots of news to plow through next week. So Mark is going to have a lot to digest economically as well as politically. So my guess, the market does not like uncertainty, and therefore you're having some very volatile markets and a weaker market rather than a stronger market just because of the uncertainty behind things. But eventually that'll chill out and things will start perking back up again. So don't get too worried about it. But anyway, if you have any questions or anything like that, let me know. Otherwise, we will wrap. Oh, wow, that took 25 minutes to get through that. Time flies when you're just chatting, right? But anyway, if you have any questions, let me know. Otherwise, we'll be back on Tuesday to find out what retail sales did and see where this market's at starting next week as we roll over these contracts. Do you think that some of the S&P futures downturn is related to the possible not passing of the federal funds stopgap? Um, you know, I'm not going to say no to that. There we go. So the market itself is, I will say, is not real political, even though it kind of is a little bit. So the stopgap funding, there's they're wanting the federal government to be funded. Yes. They can throw all these stop gaps in there that they want to. I think what the market would really love is they actually made a budget. And I think they're doing the stop gaps so they can kind of develop a budget. So when we get to our fiscal year, which ends at the end of September, begins in October, which is a long time from now, they can actually pass a budget maybe that says, okay, now we can do this for the next year. I haven't seen them pass a budget, and I don't know how many, maybe decade or so. I mean, it's been 10, 12. I don't know when the last time they even passed a budget. Everything's been stop gaps from as far as I can remember. So I think the market's kind of used to stop gaps. I'm just wondering what will happen if they actually passed a budget. That'd be crazy, right? So, but anyway, on any recommendations in tickets for gold stocks rather than future. As far as the tickers, I would use NEM. That's Newmont. I would. I mean, there's a lot of them. You can use the Wheaton Precious Metals. That's what is it now? They changed their. I think it's WPC. Um, you have AEM. And I mean GLD SLV. There's gold and silver right there. WPM. Okay. I thought they changed it, but anyway, thank you, Jim. I knew they changed their symbol to something. Um, so, but I think just GLD and SLV are probably your best ones. SLV is kind of a slow mover. I mean, it's like kind of watching paint dry. GLD moves pretty well, but you might get more movement out of like Newmont, NEM. It moves around quite a bit. So, and SLV aren't that far apart as far as price. But anyway, but I think Newmont is probably a real good one to kind of trade around with to go along from there. Yeah, PAS is silver. Um, there's one on palladium, and I'll just warn you on this one. It's PALL. It moves around with no palladium and platinum and stuff like that. There's no options on it though, so it's non-optionable. So watch out for that. But yeah, there's a lot of them out there. If you want real cheap ones, they got real cheap ones out there. What is that? EGO is one that's like $5-6 or whatever it is. Um, but I mean, you buy 1,000 shares of it, it goes up $1. There you go, right? So, but there it is. But yeah, there's quite a few different ones that are out there that you can. I mean, one thing if you're just wanting, just Google gold ETFs or gold stocks, and they'll give you a whole list of them. Pull up a chart on them, see if they're moving with gold. If they're not, then throw them in the trash can and find something else. Remember, these are actually equities. They have CEOs, they have a board of directors, they have earnings. All right. So you can have gold making new all-time highs, and you got to gold or silver stock just get hammered because basically they suck. And that's the thing that you really have to worry about. And so that's why I really like GLD, SLV, because those are just ETFs. There you go. That takes care of that one. But if you're wanting to get into those other ones, yeah, there you go. Just kind of Google the companies, pull them up on a chart, and go from there. So yeah, that RGLD is a real good one. I like that one. Um, Jim just popped that in there, and so, but I do like that RGLD as well. I had forgotten that. In fact, there's actually I got quite a few of them. Where's my there we go. Bing. But here's a whole list if you want to look at them. So, and you can just take a screenshot of that and you'll have a whole bunch of different, you know, ETFs and stocks and stuff like that. But this is a metals tab that I keep just flip over to see which metals are doing good and which ones are bad. There's actually some uranium guys in here too, so beware of that. So FCX, of course, is copper, and X down there, of course, is U.S. Steel. So, but anyway, but yeah, grab your camera and take a picture of that, and that'll give you some to look out for. Anything with a slash in front of it is futures. I think there's just copper, gold, and silver in there. HG is high grade copper. SI is silver, and gold is GC. So, alrighty. Well, thank you all for tuning in today. We'll be back on Tuesday next week, 2 p.m. Eastern, see where we're at. But thanks for being here, and thanks for having me on your speakers. But we'll see you next week.